On the NASDAQ, we had some more weight to that rally, up 0.7%. The one big sector to watch at the open is big tech. The NASDAQ 100 entering a fresh bull market, climbing more than 20%.
So the NASDAQ 100 just re-entered a bull market. We're up over 20% from previous market lows, and there's an underlying sentiment of optimism about the stock market. But is now the right time to load up on our stock investments, or should we be a little bit more cautious about what's to come? Today I wanted to share with you guys some broader stock market analysis, but be sure to stick around to the end of the video because I'm also going to share with you guys a couple of potential reasons why we might not just want to get carried away just yet. The NASDAQ 100 is a list of the largest non-financial related companies listed on the NASDAQ stock exchange. It's predominantly made up of your mega cap stock names like Microsoft, Apple, Nvidia, and Google. But it also does have some different sectoral exposure to it as well, with stocks like Costco, Starbucks, Zoom, and PepsiCo. And thanks to some good old momentum in the first quarter of this year, we're actually closing out the quarter as the best one since 2020 and the second best quarter in the past decade. So in light of that, let's take a look at the stock chart just now, and I'll share with you guys what's played out during the first few months of this year. So here is the NASDAQ 100 and what markets are particularly interested in, and the reason for all of the headlines this week is due to the recent momentum that we've seen since the market lows of about January this year, right the way up until where we are right now, where market prices have risen 22.5%. Now the reason why we know it's a bull market is twofold. Firstly, by the definition itself, we are above 20% in gains in the market, and therefore it's a bull market. The second reason is based on market structure itself. What you can clearly see is the market has made higher highs, it's then made a higher low right the way off that moving average, and then it's made higher highs once again. And if you think about the stock market like a 2D picture of a staircase, well, that's kind of what the stock market is doing in terms of moving up and then a little bit lower and then higher once again. However, based on the current levels of momentum within the market, there is one key level that I'm actually looking at in terms of an upside price target, if you like, for the NASDAQ 100. And that's back in line with the previous market highs that we saw back in August 2022, which is roughly about, well, 4.5 to 5% or so, about 4.7% from today's current market prices. However, it's also worthwhile calling out to get back to the all-time market highs back in about November 2021, then from today's current price again, we're going to need to see upside momentum of about 28%, which is a monumental amount of upside that we might not see take place in any short period of time. And actually, this is probably where it's really important to actually pay attention to percentages, because understanding the principles of portfolio drawdown is really important. You can actually see that market prices from peak to trough actually dropped about 37.8%. However, in order to actually get all of that market price back into the market, well, we need to see upside of about 61%. So you always need more upside after a period of downside has taken place within the market. It's just how the law of percentages work. Now be sure to remember this picture because I'm going to share with you guys in a few moments time potentially why we shouldn't get carried away just yet. But staying on the topic of optimism, let's talk about a few of the reasons why this bull market could continue to play out and what the growth potentially could be attributed to. So firstly, let's just talk about how the NASDAQ itself is made up, because it's something called a weighted index, which essentially means the bigger the company that's listed within the index, the more influence that company's stock price has on the index on the whole. And the NASDAQ 100 currently holds a 55% exposure to tech stocks. So you're probably not going to be all too surprised to hear that the mega cap tech stocks are one of the reasons why we've seen this recent uptick in momentum. But it's not the only reason behind the momentum in itself, because actually 73 of the 100 companies are actually green year to date so far. And I'll flash up a screenshot of the top 10 of them. The top 3 are indeed tech related in the form of Nvidia, Meta, and Tesla, who have all achieved phenomenal rates of return year to date so far, which of course has gone on to push the index materially higher. And because Nvidia, Meta, and Tesla are big players within the index, with a collective market capitalization of $1.8 trillion, they therefore have a bigger weighting within the index, more so than some of the smaller companies, and therefore can influence the price of it more. And as of right now, we're talking about gains of about $600 billion across the mega cap stock space, which is absolutely huge. But why are investors now frantically loading up on tech stocks once again? Well, there are 3 reasons why I think this is the case currently. Firstly, valuations. The first thing that springs to mind is the price to earnings ratio of the NASDAQ, which is currently 24 times times earnings, which compares to the 30 times earnings just 3 months ago. Not only that, but when you compare the PE valuations over the past 5 years, we're trading significantly below that average price to earnings multiple. And with that, it certainly appears like there's an underlying sense of value coming back into the market. Even at an individual stock level, tech stocks typically trade at very high premiums, but actually some of them are very much in line with the NASDAQ price to earnings multiple, with the likes of Google at 22 times earnings, Meta at 24 times earnings, and if I'm honest, Meta was trading at probably about 15 or 16 times earnings just a few months ago, and even the likes of Apple is trading at 28 times earnings. Now don't get me wrong, from a traditional value investing standpoint, looking at 20 to 25 times earnings multiples for a stock to invest in probably would have Benjamin Graham turning in his grave. But considering the fact that they're tech stocks, well, those PE multiples don't feel all too high. And they're certainly nowhere near absolute peak price to earnings multiples that we've seen in the past 5 years of 34 times earnings. So with that, we're probably now quite close to a bit of a healthy middle ground when it comes to tech stocks and their PE multiples, which if you think have been even more discounted compared to prices just a few months ago where stock prices were extremely suppressed. The second reason is all about the terminal federal fund rate. Interest rates, of course, have a hugely adverse effect on stock prices when they're going up. The cost of money increases, which reduces corporate profits and slows their growth prospects too. However, with the federal fund rate looking only likely to increase another 25 basis points before we hit an absolute terminal rate between 5 and 5.25%. One Fed official has actually been quoted in the Financial Times saying, "I currently anticipate some modest additional policy tightening and then holding throughout the end of this year." And with that information, investors know, at least for now, that we're potentially facing into the worst case scenario of monetary policy and interest rates. And actually, if we look into 2024 and beyond, well, forecasts actually suggest that interest rates will start to come down once inflation becomes more under control. Now, of course, the lower the rates go, the better that is for stock prices. And before we know it, we'll be into a completely different cycle. And I think perhaps we're starting to see that early stage optimism re-enter the market. Whether it's a little bit too premature, well, I guess we'll only have to wait and see. The third reason is the growth of artificial intelligence. On the topic of being optimistic, one of the main things that the mainstream media are covering right now is artificial intelligence.
ChatGPT. Maybe you've heard of it. If you haven't, then get ready, because this promises to be the viral sensation that could completely reset how we do things.
Everybody has heard of ChatGPT by now. It's a software that's built on OpenAI where you can pretty much ask it any question and it will give you the answer. Apart from which stocks that you should pick within your investment portfolio, because unfortunately it won't tell you that. So with this newfound technology taking the world by storm as the next big thing, actually it's just no different to what all of these big tech firms have already been investing into for many, many years. The analogy that I can give is it's like herding sheep. Once one of them moves in a different direction, all of the other sheep follow along.
I fucking hate sheep.
It's kind of like, oh, we've got this newfound AI technology thing, so let's dump all of our money back into tech stocks. I mean, I could be wrong, but with all the mainstream media coverage, I certainly wouldn't be surprised that that's the case. But despite those three reasons being the catalyst for higher market prices, it might not be all that it seems. Let me explain by going back over to the stock chart. So right now, as you guys can see, we're very much in this kind of uptrend of momentum, where we've seen, as I said, about 22% worth of upside since the absolute lows of the market. But here is one of the big reasons why we shouldn't get carried away, and that is that you can get bull markets within longer term bear markets. I think we can pretty much all agree that we've been in a bear market since absolute market highs of about November 2021, and you can see the steady decline in market prices throughout the course of 2022. But within 2022, we also technically saw a bull market playing out, because market prices at the absolute lows in June actually went up in value about 24% through to August 2022. And with that, we also broke the previous market high in the market, which could certainly have suggested that market prices were going to continue to go higher. But actually, the opposite happened. Unfortunately, this piece of upside momentum here was just a pullback as part of a longer term downtrend. And essentially, that's exactly what we could be potentially seeing now based on current market structure. It could just be a pullback that could end up in more downside momentum. However, there is one critical area in the market that I think everybody should pay attention to, and that is the previous market high at 13,700 points. If market prices continue to move move higher and we breach this level of 13,700 and we go on to truly make new highs, then I think we can be slightly more confident that market prices actually may continue in this bull cycle. However, I do believe if we fail to break this key level and market prices head back down towards the downside, well, I do think the worst is still yet to come. But for now, I'm staying optimistic, especially as my trading 2-on-2 investment portfolio flashed green once again today. So with that said, guys, if you do want to see what I'm doing with my investment portfolio right now, then be sure to click on that video next. Be sure to drop a like on this video and subscribe to the channel on your way out. And with that being said, I'll see you over in the next one.